Hi, everybody. How you doing? It's your buddy Uncle Bruce here. Welcome to our class. It is Sunday, June the 18th, 2021. This is lesson number 4. And the lesson is called Using Aggressive Trading Strategies to Profit from Writing Stock Options. And so we're going to talk about the writing angle again today, like we did last in lesson number 2. Lesson 1 and 3, we're talking about buying and selling options. Lesson 2 and 4 are about writing contracts on stock options. Welcome one, welcome all. There are a number of ways that you can write options. Of course, I have been going over this now on my channel for a few months, mainly talking to you folks about writing options on GameStop shares or on AMC shares, where you can bring in enhanced revenue, income revenue, by being a shareholder of these companies. You might as well be being paid while you're waiting for the payoff on your investment. And a number of you have figured out that, hey, writing these contracts, man, I can bring in some serious money here. This is pretty good, whether I'm writing weeklies or monthly contracts or longer, depending on what kind of risk tolerance I want to subject myself to, or what kind of how often I can watch the market, how closely I can watch and monitor my stock. There's a contract for me. And on GameStop and AMC, because of the high premiums, you're able to write contracts at pretty good premiums. Short term, you can write 1 and 2 week contracts and bring in some good money. You can also write longer term contracts and bring in some really big money. And we've covered that a little bit last week. We're going to cover some more of that this week. But I'm going to talk to you today about a few more aggressive moves you can make to be, if you really want to bring in some cash, and you're willing to, quote, put your shares up for, quote, sale, where you're not afraid to be exercised, and you shouldn't be ever. Some of these strategies I'm going to talk about might be for you, okay? As always, you can ask a question of me by just typing in your question. Jen is monitoring all the questions coming in, and she'll interrupt me from time to time if I'm talking about stuff that's over your heads, or I'm going too fast, or
I should get my Nerf gun.
See, she's thinking I should get the Nerf gun. I can just shoot you.
Get his attention.
Yeah, I can shoot you in
over the bow.
Yeah, over the bow or below the belt. And there's a question. There's something else. I don't think I'd like this idea.
Never below.
I'm not a fan of it. No, okay. Jeez, this is tough. This is not easy. All right, let's talk about a couple of ways you can write options, and that are a little more aggressive than maybe what we've talked about so far. Okay, let's figure that out. The first one is writing an in-the-money call. Way in the money call. Why would you do something like that? What are you, crazy? It can be done and is done. Let me talk about this. First of all, I'll talk about GameStop first. We'll talk about SPACs as well, but I'm going to talk about GameStop at this point, all right? So GameStop, GME, the shares closed Friday night, $168 approximately. Way too low for my liking. I sure don't even like how I write this down. I can't even write today. Closed at $168 a share. There we go. Does that make sense? Can anyone read that? All right. That was on July, 2 days ago, right? Today's the 18th, 16th, right? 21. All right. Now, writing in the money calls. So why would you do that? First of all, let's suppose you are, you suspect, you feel, you have the hunch, you can't shake it. You think that the GameStop shares are going to drop back to the 140.50 level. Sacrilege to think, but you just think that the shares are going to take a dip. And you want to really make a score out of this, all right? I have pulled up here some August the 20th contracts. So let me show you these off to you, okay? August 20 expiry contracts. Now these last about a month. These are like 4 weeks from now, okay? That's when they expire. You could sell or write a call option against this stock in the money. And I'm looking at a $150 call contract right now. So this is $18 in the money. All right.
Has
On
to be 100 shares.
And you have to own 100 shares to write a contract. 1,000 shares, you can write 10. 500, you can write 5. However many hundreds of shares you have, you can write a contract against as many as you wish. All right. Assuming this is just a one call example, multiply it as much as you want. If you think the shares are going to go back to under 150 for like a second, an hour, a day, for a couple of weeks, they might go into the 145.50 range for a little while. Just suppose, all right? Or even your thoughts are, well, Bruce, I bet you by August 20 or so, a month from now, these shares could be 140 to 150 a share. Don't like it, but what if they are? How can I make money? You can sell, as of Friday night, you can sell a 150 call for about $31 a contract. So here we go, 31 bucks. Now, you multiply that by 100 shares because each contract is 100 shares, right? This is $3,100. All righty? So $3,100 would come into your option account in cash right away, 3,100 bucks. Now, if the shares stayed at 168 and didn't move an inch between now and July 20, they just stayed at this price, you would be $18 in the money. These contracts will still depreciate down to $18. Theoretically, if they go down to $18, you just buy them back at $18. And even though they're in the money, you just buy them back and you keep the $13 differential. You made $1,300 on a contract without the stock doing anything from here. If it just stayed at 168. If the shares obviously go up in price, say they go up to 180 bucks a share on the 20th of August, the end of this contract right here. The shares go to 180. Let's write that over here. 180 is the price of GameStop on August the 20th. This call will be worth $30 in book value. It'll be worth 30 bucks, and you'll have to buy it back to get out from under, or you're going to get exercised. Person who owns this contract is going to buy your stock from you for 150. They've already given you 31, so you sold for $181. But you'll buy the contract back for 30 bucks, and you will make a $100 profit on this mistake, on this trade where you were wrong. You thought the stock was going down. It went up. Even though it went up to 180, you still made $100, even though you were wrong. Wow, that's pretty good. Okay, now let's go the other direction. Let's do this other example, as I said earlier. Let's say they do go down to 160. They're at $160 a share on the 20th of August, right here. This contract has a book value, because it's a 150, of $10. It's worth 10 bucks. You've made a profit of $21 a contract, or $2,100 in profit for you by writing an in-the-money contract. Again, you sold it for 31. You're going to buy it back for 10 because that's all it's going to trade for on the last day of its life. You're going to score a $2,100 profit. Let's play this little game. You write this contract Monday morning for $3,100, all right? By Wednesday afternoon, we have one of these short attacks on our GameStop like we see all the time. And GameStop goes down to 155. Intraday trade. So it's dropping $13 from where it is right now. $13. What would the contract be trading for if the stock dropped $13? Okay. It will go down to about $22 a contract, ballpark. I'm just looking at what the others are trading, all the other contracts are trading at higher levels. I can tell you that if the stock drops off $13, this contract will go down to the 22 range. You will be up $900 on Wednesday. Keep in mind that if this happened a week later, the next Wednesday it dropped down to that level, this contract will drop even more, because what is it losing? Time value. Because remember, at 168 on the open market, you can get $31 selling this contract. It's only worth $18 in real life. The 150 versus 168, it's only got an $18 book value, but you're getting $13 time premium by selling this thing. But in 2 weeks, there won't be $13 time value left on this contract. It'll be down to like 7 or 8. And so the lower the stock goes, the lower the time value depreciates. the more money to you. And that's why at 160 at the end, you're only buying this contract back at 10. If the stock closes at 150 on August the 20th, right here, closes at 150, this contract is worthless. It has zero value because it's a 150 call. The stock's at 150. The contract has no value. You get to keep all $3,100. You've gained all $3,100. If you hung it out, you stuck around and didn't do anything. You just wrote this contract for 1 month, and it expires. The stock's at 150 at the end. You're down $18 on your stock. It went down from 168, where it was trading Friday night, to $150. So you're down $1,800 on your 100 shares. That's the bad news. The good news, you're up $3,100 in your account, your option account. You have $3,100 cash sitting there. That's the $1,800 you lost on your stock, plus a $1,300 gain on the time depreciation from July to August. You've got $3,100 cash. Now, are you going to buy stock with it? You can buy 20 more shares, $150 a pop. You can buy 20 more shares if you want. You wrote 10 of these. You brought in $31,000. It's all yours. You can buy 200 more shares, which will now let you write 12 contracts. Maybe. This is just an example of an in-the-money, aggressive call where you're saying, I know I can write a 165 contract. I know I can write a 170. I can write a 180. I can write a 190. But if I write those contracts, I won't get $3,100 in cash. If I write an in-the-money contract, I'm getting book value plus premium. Question is, though, will I get exercised right away? What if I get exercised? What happens to me? Is the world coming to an end? Am I done for? No. Actually, you would be a happy camper if you did get exercised. Why, you ask? Well, I'll tell you why. Let's say the stock's trading at 165 on Monday morning, Monday afternoon, just after you wrote this contract. Stock's 165, and you get exercised. You'll get bought out for $150. Well, that's the bad news. What's the good news? You already brought in $3,100 this morning. You brought $31 a share in. You got taken out at 181. It's sitting at 165. You want to be exercised. That would be terrific because the contract is out. You keep the $3,100. Now you got $15,000 more for your 100 shares, assuming just 100 shares.
Say that again. They still have to pay you.
That's right.
For the share.
If they exercise you, they have to give you $15,000 for every 100 shares that you've written a contract against. I'm assuming one contract here. You're getting $15,000 plus the $3,100 you already got. You got $18,100 for you to buy back the stock. To get it back, you go to the open market. If it's trading at 165, 168, you're paying $16,500 or $16,800. You have $18,100 with which to use. Keep the change, as we say in the tipping business. This is wonderful. You would love to be exercised because you've guaranteed yourself $181 a share, the 150 exercise price plus the $31 a share you got paid for selling this contract. You're either going to buy it back for a lower price or you're going to let it expire for zero. But let's say you are really wrong. You screwed this up royally. The stock really went up on you and the fear has come true. You keep telling me, I don't want to lose my stock. What if it goes crazy? Okay, let's say it goes crazy. We're allowed to go crazy. I mean, Prince did a song called Let's Go Crazy, didn't he? I mean, all right, let's say the shares go to $200 a share in 2 weeks. They're sitting at $200 a share. All right. I hope you can read this down here. At $200 a share, this contract is in the money. It's a 150 contract, isn't it? It's in the money $50. So it has a $50 book value per share, and it still has time value left, right? Because this is happening in 2 weeks. There's still 2 weeks to go in this contract's life. So we're going to add book value, that's BV. Book value is 50. Time value, TV, is probably going to be about 8. The more in the money these get, the lower the time value shrinks. It might even be less than that, but I'm going to give you a guess. $58 is the value of this contract. What if you get exercised? What happens? You will get $15,000 cash because you have a 150 call. You keep the 3,100 in cash you already got. You got $181, but the stock's at 200. That's the bad news. The bad news is you thought the stock was going to go down. That's why you wrote a 150 call against a 168 stock price, but the stock went up and you ended up taking $181 instead of the 168. You got 181, but it went up to 200. What do you do now? What do you do now? You curse to the heavens and say, how could you let me down like this? I thought I was so right. On the other hand, you go, well, I am up $1,300 from where where we were. I mean, I got 181 for this 168 stock. So, okay, I got some of my money back. You could just turn around and say, well, I'm going to give it all up and go into, I'm going to become a priest or a nun. Or you could say, well, you know what I'll do? I'll just buy the stock back. Why don't I buy the stock back for $200? You'll have to come up with $1,900 extra dollars to buy 100 shares. I was getting there. You could buy the stock back if you have the money at 200, immediately turn right around and write a new contract against the stock. You could write a 180, an in the money call, good for a month, again for about $30 to $35 a contract, bringing in $3,500 in cash. You just had to spend $1,900 to buy those extra shares. You just brought in $3,100 more fresh cash. You just got all that $1,900 back and an extra $2,000. And you're saying to the market, take me out at 180. I dare you. I dare you. You just gave me 31 cash again, or 35 in cash. You're going to give me 35 now and 180 whenever for like a month, but only a month. That's $215. I dare you to take me out. I just made another $15 on this stock. I bought it at 200. You can take me out at 215. I don't mind. You can take me out. But what if the shares do go back to 175, 180? You're right. They did go down, but they went up first and then they went down. The option expires. You wrote a $200 contract, and the option is now sitting. The stock's trading at 185. The option is worthless. You keep all $3,500. Thank you very much. Guess what you do now? Gee, I just had my contract expire. It was a 180. The stock's at 185 or whatever it is. Or I had a 180. The stock's at 175. I'm going to write a 150 contract. Again, I guess what I'm going to do. I'm going to write one of these, but not an August contract. I'm going to write an October 20, probably by this point in time. We're going to do it again and again and again. And I'm going to keep telling this stock, I dare you to prove me wrong. I'm prepared to have my stock bought away from me for the premium. I'll take the premium. But I'm betting not even the farm, I'm betting these 100 shares that I'm not right. I'm not wrong every single time I do this. I bet you that the time premium is going to pay me dramatically, handsomely. This $13 difference between the $18 book value and the $31 price that I sold this for, this $150 contract, has a $13 a share premium on it for 1 month. I want that premium. I bet you I'm going to make it each and every time, almost each and every time. Maybe during the months, during the time between July 16th and August the 20th, during this time frame, 1 month, the shares might go down to 145 for 15 minutes, an hour, a day. If that happens, these calls will go from 31 to 15 or 31 to 10. And you could elect to, I'm going to buy these calls back. I know I have 2 weeks to go, and we're out of the money now. I've got 150 calls and the stock's at 140, but I can buy them back at $10. I think I will. I'm going to buy them back at $10. That locks in a $21 gain on this transaction. I make $2,100. Yeah, my shares are down in value, but now I'm free and clear of the contract. And then what I'll do now is I'm going to wait for a little recovery. So maybe this thing will bounce back to 150.55. And maybe at that point, I'll write brand new contract for a month out with a 140 price, if that's what I want to do. Or I can write a 150, or I can write a 160 out of the money for a month or so. Won't get $3,100, but I have the options. I have the choices and the ability, the flexibility to write whatever I want, whenever I want. All right, questions?
They're saying how one of the possibly a problem with GameStop is that it got caught in that meme short squeeze and rapidly went to $350.
Right. Yeah. A month ago, 2 months.
A month ago, yes. And so then you're hooped and there's really nothing you can do about it.
Okay.
But how often does that happen?
Twice in a year.
There's a reason
we've
people
had
are
this.
calling it a YOLO. Like
Yeah. And even during that point in time when the stock did that, recall what happened every day over that 2-week time frame. We went from the 170 range, 160 range up to the 210, 20 range. Then we got into the 250 neighborhood. We backed off into the 200s. We got back to 280. We went back to 220. We got up to the 300. We went back to 250. Then we got up to 330. We went all the way back down to 250, back up to 280, all the way down to 220, back to 250, all the way down to 180. Here we are. This is happening all the time, this stock, all the time.
Riding the train.
The problem right now, of course, at 168, we're not going to move $50 each day now, because at 168, a $20 move is a big deal now. Think about this. The stock's trading at 330, and you would have written $300 call contracts, good for a month. You would have received about $60 a share at that time. Okay. You're into this thing at 170, 150 a share. Some of you are into here at 110. You wrote a contract for $60 and you did nothing. You did nothing because the stock went down to 250, went down to 220. That $60 contract went down to $5 like that. Now you buy it back. You scored a $55 gain. What a home run ball. And now you're writing whatever you want to write going forward. Now, some of you at the 300 mark, 280, 300 mark, you started writing $500 and $600 call contracts because you heard me yelling, hey, listen, you can write contracts for like January and you can get $80, $100, $90 a contract. You get $60, $70, $80 a contract for writing 500s, 600s. And if you get taken out, you get the $600 plus the $80 or the $60 more. You're getting $660 if you get exercised. I mean, hello, take that deal. Some of you took me up on it and you wrote contracts up there. And then the stock did come back down to 250, 220, and you watch those contracts just shrink by half in no time or more. Some of you bought them back. Some of you still have them. You still have them out there. And now at 168, those 600s you wrote at 168, I mean, they're, what are they trading at? $8, $10? Well done. All right. But
Christine is saying she can sell a contract that expires July the 30th in the money at 165 for $15.10. So even if she got exercised, she wouldn't be at a loss if she got exercised right now at 168.
Okay, let me hang on a second. Let me repeat it. Let me get this.
So it's a 165.
Okay, it's a July 30. A 165 July 30 call or put? Call.
It's a call. You're talking calls.
And she can get what? Read that to me again. She can do
$15.10.
Yep.
So even if she got exercised,
180.
She's ahead of the.
That's right. That's right. And that's correct. You can write a call contract that expires very shortly from now, in or around or at the money. I mean, you wrote 170s, you could get about $12 for those.
You can write 3 of them.
That's 300. That's right. Yeah. And 300 at $16 a pop, that's $4,800.
So what
in your account.
is the rationale for a 1 month expiry rather than 1 week or 3 weeks or 3 months?
The amount of money you can get per contract. The longer the contract lives, the more premium it'll bring you. And you can then maybe write it closer into the money contract or further out. You can play either way. Let me take a look here at something closer. Where am I here? This is a July 20. Okay, this Friday. All right, let's talk about this week. Okay, let's play this game. Here we go. I'm gonna wipe this out of here. All right.
And then could you do all of this all over again with SoFi?
Okay. Well, or something like that. All right, hang on. All right.
Examples are good.
Examples are always good. Okay, GameStop is at 168 on Friday. Okay, $168. Okay. July, we want to write July contracts that expire this coming week. July 23rd contract that die this Friday night. All right. Let's take a look at different contracts. Okay, a 165 you can get about 1054. So July, a 165 call contract, you can get $10.50 right now. premium, which is 1,050 in total, times that by 100. If you write at the money a $170 contract, you're going to get about 775. So the 170, you're going to get 775. Okay. Again, these die in 4 days. 4 days. So even if you write an at the money or just out of the money or just in the money contract, you can get between 775 and 1050 a contract for 5 days. Well, from Monday to Friday. All right. Write these Monday morning and Friday afternoon. If the stock is under 165 or under 170, these contracts could be worthless. If the stock closes at 168 next Friday, this contract is worth 0. This contract is worth $2 because of the 168 value versus a 165 this is worth $3. Pardon me. This is worth $3. It's 3 in the money. This is 0 value out of the money. Okay. If you want to write a 160 contract that's further in the money, the $160 contract would bring you about $13.50 a share. Now you're gambling here again, aggressive strategy. This is being aggressive. You're saying to this market, I dare you to hang around here because I've been watching you the last 2-3 weeks. You're going down right now. You're going up and then you're going down. You're going to lower lows and lower highs, lower lows, lower highs. What if you do go down to 150 a share? You can do this. We know this stock can do anything. If it drops under $160 a share by Friday night, you keep all $1,350. This is $1,350 a share times 100 shares. That's $1,350 in your pocket for every 100. You have 300. That's $4,000, like $3,950 US dollars in your account by writing in the money contracts very close to expiry. You're not giving the stock a lot of time to recover. Yes, we could have an announcement at any time that could make the stock pop. Yes, there could be an event happening that could make the market go up. But also, yes, there could be a time where the stock, it just fluctuates down when the market goes up and there's nothing we can do about it. We've seen this do everything. What I'm thinking about for you guys is what happens on Wednesday or Thursday of this week if these shares give up a little bit of ground and they just reach this 155 level for a little while. They just hang out there for all day Thursday or all Thursday morning. Well, at 155, these 165s are way out of the money by $10. They'll be trading at like at 3 each. The 170s are like worse. They'll be trading at like $1 or $2 at that. And the 160s, like I say, at 155, even these guys are out of the money by $5. These will be down to $7 or $8. And so you've got an opportunity here to not necessarily score the full return on your money. You're not going to hold on to these for the full last day, theoretically. You might be of the mind to say, as soon as these things drop by 50%, I'm out of here. I'm going to buy them back. I'm going to lock in my profit. So your mentality going in is on this contract right here, if I make 550 profit, I'm taking it. And I don't care what happens after that. I'm off. I'm here to get 500. I'm here to get 375. I'm here to get $675. This is what I'm looking for. I'm looking for a quick flip. I'm an aggressive trader. And in days, I want to make this kind of money on my money. That's what your thinking is. You're using your stock as the bait. You've got it on the end of a fishing lure and you've thrown it into the lake and you're saying, come and nibble at it. Come and nibble at it. But if these shares fluctuate, which they will, these contracts could go up or down in value. Now, again, if the stock does go higher, closes at 170, these are at the money, they're worthless. These are worth $3 and these are worth $10. So if the shares do go up a couple of bucks, you still make money on all of these. If the shares go to 175 Friday afternoon, this contract will be worth $10. You basically break even on it. This contract will be worth $0, or it will be worth $5. Pardon me. It's just at 175 close. This is worth $500. You still keep 275 profit. And this is worth $15, $1,500. You lose $150. You finally lose money. The stock went up and you lose money on this contract. But the good news is your stock's worth $175. It went up $700 in value this week. You only lost $150 here, year ahead, $550. When you write contracts, you score the time value. That is your payoff. Time. Even if you're wrong, the time value is yours. You're only on the hook for the book value between what the contract is worth and what the stock is worth at the end of the deal. And in the middle of the deal, between now and Friday, these will fluctuate in value as this fluctuates in value, as you clearly are aware. This is why I'm saying aggressively, you might decide, yeah, the heck with this. I'm going to write an in-the-money contract. That's what I'm looking for. Now, again, this is a 4-day, 5-day deal, right? This dies this Friday. The other example was a 1-month deal where I gave you much more time with which to either buy back the contracts on dips. When the stock dips down, you buy back your contract. Stock comes back up, you rewrite the contract. Stock goes back down, you buy back the contract. If your mentality is, I want to score $500 every time I buy contracts back. So every time the contract drops in value, the stock drops and the call goes down, $500 profit, I'm buying them back. Stock comes back up again, I'm rewriting a new call. It might be the same exact call, or it might be the same strike price call, but for a week further out, because after a week, you're now going to stay 30 days ahead of the market. You're always wanting to have a contract that's 30 days ahead of the expiry date. So if in the next week you buy it back and then you rewrite an August, a week longer contract, and then you buy it back the next week, you write a new one into September, you buy it back, you write one into the second week of September, you buy it back, you write one into the third week of September. You're always 30 days ahead of the market, and you're always in the money by $15, $20 a share, always, and you're always looking to cash in on the appreciation of the time value of this contract. That is an aggressive call strategy. You're taking in big premiums against your stock, and you're using it as a sacrificial lamb to make this money, knowing that, yeah, you buy me out, you got to pay me. Okay, I'll take the cash and I'll turn around right now and buy stock back, because after 3 or 4 of these, after like a month or 2 of doing this, 5, 6 weeks, you'll have made a whole ton of dough. You'll have all kinds of cash to buy your stock back if it goes up on you. You don't mind. And again, it goes up, that's fine. You buy them back and rewrite brand new contracts. Whether they're in the money, at the money, or ahead of the money, you'll decide at that point in time what's the best prudent way to go. If these shares want to pop up $75 in a week and go to $250, and you bought them back, and now you're waiting, you're watching the stock go to $250. Now you're going to say, I might not write 225s, but I'll write 275s for a month. I can get 30 for those or 25 for those, because the premiums will start to rise up in value again, because the stock is moving up in price. You'll play the angle as you see fit. More questions?
I don't know, because I was gone for a moment.
Yes, ma'am.
Did you see Aurora is saying, does one use in the money calls if you think the stock will stay about where it is or go down, and out of the money calls if your hunch is that the stock price will go up? Or is it just based on your risk tolerance? It's always based on your risk tolerance.
Always based on your risk tolerance. If you're just a call option player, because I haven't talked about puts yet, if you're just a call option player, you can play the game where I don't think the shares are going to go above a certain price. They're not going to go over 180 right now. They're not going over 200 right now. I don't think they can go to 200 for another 3 months. Whatever your thought process is. If you don't think the shares are going to go up over 180 or 190 or 200, well, then you have a field day in front of you to write, say, 2 weeks, 3 weeks to 6 week contracts that are 180s, 185s, 190s. If you're an aggressive player and you're saying, I know these shares fluctuate, I know it. I'm a GameStop shareholder. Of course I know the GameStop shares fluctuate. And I'm not afraid of being involved in this stock for plus or minus $20 from this level. It can go to 188 or it can go to 148 at the drop of a hat, because I know how GameStop acts. I'm not afraid to write $150 call contracts. Now, you might not write a $150 call contract that expires in 5 days, but you might write a $150 call contract that has a month to live or 6 weeks to live. You'll play that angle because you know and you feel that in the next 1 to 2 to 3 to 4 weeks, it could be that at any time the GameStop shares might reach 145, 150 a share. And if you've written $150 call options, now while the stock's at 168, 18 in the money, on top of the time premium of 4, 5, or 6 weeks, you could haul in anywhere from $30 to $40 a contract in cash, depending on how long the contract has to live right now. And your attitude is, you know what, man? You give me $40 a share. You hand it to me on a silver platter. I'll take the $40 a share. Take me out at 150 because I'm selling at 190. That's what I'm getting. You're paying me 150 on the exercise price, and you gave me 40 up front. I'm selling for 190. So if the shares go up to 175, 180, yeah, take me out. I'm getting 190. I'm protected to that level. This earlier example I talked about, this August example with the $31 premium, that's a 181 sell price. So up to 181, you're covered. It's 168 right now. So the further out you go, the bigger the premium. Yeah. Any more questions?
Yes. Sean and Wendy are saying the YouTube viewers, your community, they're saying that the GME options are expensive now.
Yeah.
Is it cheaper now when you write the call compared to,
yes,
I guess buying a call is what you said. I don't know.
I love the GameStop options if you're a writer. I hate the GameStop options if you're just going to buy the contract. You want to buy calls because you think the stock's going to go up. I hate the idea of any of you buying call options because the premiums are so ridiculous. They're still high. I want you to take advantage of these ridiculous premiums by being a shareholder and offering up your stock. That's really what I want you to do. I want you to cash in on this silliness of these contracts. I want to take a peek here quickly at September calls and puts. I'm going to take a look at September's. If you wanted to write a $150 call option against your stock on GameStop for September the 17th, you will be paid $40 to $41 a contract for September. So you're selling out for 190, 191 for September the 17th. This is July the 18th. 2 months, 60 days. You're saying to the market, you can have my stock for $150 a share. Just give me $40 right now. Give me $4,000 for these shares. I paid $150 for them. I'm going to take $4,000 right now, and I'll take $150 for them between now and September. That's $190 you're offering them for. The shares touch $140 a share in the next couple of weeks. These $40 contracts are not going to be at $40 anymore. If the stock drops $20, these contracts will drop about $15. They will go down to $25. You can buy them back at $25 if you want, score a $15 gain if you like. On the other hand, if the shares drop more, they go to $130 just for a couple of days, these contracts will probably drop down to about $18, $15 a piece. You'll buy them for less than half what you sold them for. Buy them back, sit on the sidelines. Stock recovers a little bit to the 145.50 level, 155 level. You might write brand new contracts. They might be 140s now for October, and you'll bring in $40 a share again and defy the market to take you out at 180 because it's 140 plus the 40 and the cash you're sitting on, which is $20 a share. You're actually now at $200 a share in total cash and value. Cash and prizes. You got your stock at 140 and you have $60 in cash. The 40 you just got and the 20 you just made on the series on that last batch. What you do with that $60 is either use it to buy back the contracts when you feel the necessary to do so, or you might decide, at 140 a share, I'm going to buy up a bunch of stock with the $60. I'm going to buy up a stock at $60. I get $6,000. The stock's at 140. I can buy a whack of this paper on the dip. I'm now acquiring more GameStop. Now, if you've written 5 contracts and you've hauled in thousands and thousands of dollars, you have enough to buy 100 more shares or 200 more shares, you're now writing more call contracts. In effect, you're making your stock buy you more stock to write you more contracts to leverage it up. Interest on the interest on the interest. All right. This is a strategy that you can employ. If you're aggressive on taking advantage of the swing of this stock, and you know how the stock can go down a lot faster than it can go up, We've seen GameStop go down $25 a share, but only come back 15 and then 5 and then 5 and then 10. You know how it is with these dips, all right? That's one of the strategies you can play. I did cover a second strategy, which is writing options with less than a week to go. It's Wednesday afternoon, all right? The contract expires every Friday. And on this Wednesday, you saw your stock move up to the 168 level. And it was at the 150 level a few days ago, got to the 168. And on Friday, you're sitting here going, you know what? I bet you Friday this is going to close at 160. Why don't I write a 160 call right now with 2 days to go? You might haul in about $11 or $12, $2 or $3 more than the book value. And if the shares do back off to the 160 mark or 162 on Friday afternoon, you're only on the hook for $2 on a $12 sale, or you're on the hook for $2.50 on a $10 contract sale. You're making $7.50 in 2.5 days on 100 shares, or on 7,500 on 1,000 shares. You can play that game as well. Put contracts. I want to talk about put contracts before we move on. You can do the same on this GameStop in puts. All right, let's play this other game called put contracts. The stock closed at $168 a share on Friday. You believe that the shares are, generally speaking, going to go higher from here over quite a period of time. Okay? So let's take a look at these Septembers. I'm just going to write these out. September 17th. Let me write this date down. September, right here. September 17th, 2021, call contracts. I'm sorry, put contracts. Let me get this. Puts. All right, we're gonna play some puts. Now, you're gonna write a put contract, and you're going to say to this market, I think you can go higher rather than lower between now and September 17th. A lot higher? Don't know. Doesn't have to be, but I think you can go higher. And I want to write an in the money put contract, so that if the shares do go higher, these puts will go down in value. All right. We're at 168 on Friday night. All right. On Friday night, you could have written a $190 put contract right over here. 190 put contract would have brought you $45 a share. $45. Okay. All right. Or $4,500. All right. Now, the stock's at 168. This is a 190 contract, all right? The difference between the 168 and the 190 is $22. So there is $23 of premium into this deal and $22 of value, book value into this deal. So theoretically, someone could sell you stock at $190 a share. They could right now say, here's my stock. I want $190 a share for it. But they've given you up front $45 in cash. You're actually only buying this stock for $145 of your money. It's $45 of the premium you got, but $145 of your money gets you to this. The stock's at $168. Would you mind buying GameStop right now at $145 when it's trading at $168? I don't think you'd mind. I'd be delighted to pay $145 for a $168 asset. Yeah, I'm ahead $2,300. Sure, yeah, you betcha. So even if you have stock, you're using stock as your collateral. You're using shares that you have. You're writing a call contract against stock, and that's trading at 168. You're writing a put contract. Sorry, you're writing a put contract for 190 against stock you've got. You're going to get $4,500 cash right now for the privilege. All right, what happens if? Let's play this scenario. The what if scenarios. What happens if the shares go? Let's say they go lower. All right, so the shares go from 168, say, to $150 a share. All right. You thought they were going up, but they now are going down. This contract between here and here has a book value of $40 now, because someone can sell you the stock for $190, and you can only sell it on the open market for $150. So there's a $40 of book value right there. This is BV, book value. And then time value, if this happened, let's say next week, by Thursday, Friday, with 3 weeks to go or 7 weeks to go, this contract will still have a time value on it, likely about $10 a contract. It'll be worth $50. You're upside down $500. you've lost 500 on this deal. Because if you were to buy the contract back right now and just give it all up, say, oh, that's it, I can't stand it, I just want to buy this call back and I want to stop this whole nonsense, you'd buy the call back or the put back for 50. Buy the put back for 50, which is $5,000. You only receive 4,500 when you sold the put. You've lost $500. All right, that's step number one. Scenario number one. Scenario number two, however, the stock does go up. It goes to 180 in the next couple of weeks. You were right. The stock is going higher. You're a genius. Fabulous. This contract only has a $10 book value. The difference between the 180 price of the stock and your contract, the put contract you wrote for 190, it only has a $10 book value, not a $40 book value at 150, but now only a $10 book value. And time premium, if this again happened next week sometime, this time value will likely be about 10, maybe a bit more, but let's just say it's $10. This contract is trading at $20 each. So the put now is trading at $20. You wrote the put at 45. That's a $2,000 value versus $4,500. You're up $2,000. All right. Just suppose we're coming down the time. The time is passing. And we know we have a September 17th contract. September the 10th, the week before this contract expires because of its timing, the stock is 168. It hasn't moved. It's just 168. All right. It's done all kinds of gyrations, but you didn't do anything. You didn't bother with anything, but the stock just kind of found itself back to 168 with a week to go. The book value of this contract, there is a book value. They can sell you the stock for 190. They can sell it to you for 190. The stock's at 168. The book value is $22. Here we go. It's a $22 book value, just like the day you wrote it. Same thing, except the time value, here's BV, but TV, the time value, we only have a week to go. We don't have 7 weeks or 8 weeks to go. We have 1 week to go. This contract is only going to have about a $3 or a $4 value to it for time. It'll be trading at maybe 25. You sold it for 45. You're up $2,000 on 100 shares. So the time depreciation is your real buddy here, because when you write this thing for $4,500, you are only offering or getting, there's only $22 of book value in this deal, 168 to 190. The reality is $23 of the $45 or $4,500, $2,300 is time, and that's coming your direction. And here it came from $2,300 down to $300 with only a week to go. With a day to go, 1 day to go, the stock's at 168. This contract is worth $22.50. It won't go any lower than 22 if the stock's at 168. It'll go lower if the stock goes lower than 168. Yes, you'll make more. Or higher, actually. Sorry. Yeah.
So, if you own the shares,
yes,
because you're writing
yes,
a put,
yes,
you don't have to actually buy the stock back. At 190, you can give them your shares. So what happens when you're exercised and you've written a put?
The brokerage firm is going to want to come up with, they're going to want you to come up with $19,000 if you get exercised on this put contract, because the price that you have to buy it for is $190 a share. However, in your account in cash, waiting is $4,500 already, because that's what you got paid when you sold this put for $45 a share. So you've got $4,500 of the $19,000 you need in your account in cash. You also happen to own shares of GameStop. You have 100 shares of GameStop, for example, when you wrote this contract. You have 100 shares. So the broker knows that we can sell your stock for you in the open market, get that money, plus add this money to the deal, and there's the 19 grand you need to buy your stock. So if your stock is trading at $168, they don't even have to sell all 100 shares. They only need to sell enough stock to bring in $14,500. They don't have to sell all 100 shares. But when you get exercised, your broker will immediately debit your account the $19,000 against, but also take into account your credit, and the credit is $4,500. In effect, you're only debited $14,500, and the $14,500 will come from the fact that you will just sell the stock. Now, keep in mind, you have 100 shares now. You're just getting another 100. You're going to have 200 shares now because you had 100 and you just bought another 100. So you're immediately going to sell enough stock to bring in the $14,500 you need to close the deal. If you're trading at 168, you're laughing. You're happy as can be because you're $2,300 ahead on this deal right here. You're up $2,300. Yeah.
So the difference between buying and writing is the risk of how much money you might have to pay. When you buy, you know you can lose the amount you paid.
Yes.
When you write, you can have much bigger losses.
No.
Okay.
You can't have much bigger losses. If you buy a call contract, look at this transaction right here. There are two people making this transaction. If you're the writer, you're the seller. All right. Someone has to buy this from you. Someone has to give you $4,500 in order for you to get $4,500, right? So there's a buyer for this deal against you being the seller of this deal. Now, why would the buyer pay you $4,500 for this 190 call? Well, the thinking on the buyer side is that you're wrong.
This is a put.
This stock is going to go down in value and not up in value, and they think they can make money. The problem for the buyer of this put, though, is they're paying a $45 price to get this contract, and that the stock has to drop enough to make them money. The stock's 168 right now. This thing's only worth $2,200. It isn't worth $4,500. It's only worth $2,200 because this contract, this 190 put contract, is only in the money $22. The difference between 168, where it's trading at, and what you can put the stock to the guy for. And so the buyer of this contract has the right to make you buy their shares from them at 190. Yeah, that's right. But they already paid $45 to get that right. And in effect, they're only getting $145. They're not getting the full 190. They paid you $45 up front for the right to sell it to you for 190, and it's only at 168. So they're on the opposite side of your trade. It's a two-person scenario. So if the shares went down to $150 at the end of this contract, September 17th, the stock was 150. What would the value of the put be? The put value would be $40. The difference between 150, where it's trading at, and 190, where they can sell it to you at. The problem for the buyer of this contract, they're still losing money. They paid you $45 a share. They're only getting a profit of $40 a share at 150. If the stock goes down to 140 a share, now they're in the money because they can sell it to you from 190. It's only worth 140. They can sell it to you 190. There's a difference of $50, and that's $5 more than they paid you to do this deal. They actually are betting much worse than this. The buyer of this contract isn't saying the stock's going to go to 140 or 145. They're saying it's going to 100. They're gambling on a big return. They're thinking it's going from 168 to 100 a share. And if the stock goes to 100 a share, the put value is $90. All right. And they paid $45 for it. They make a profit of $45 a share on the contract. They make a $4,500 profit. If the stock drops to 100, from 168 to 100, that's what they need. What do you think the odds are of those guys making that kind of money? Well, there are people who are gambling it'll go to 500 a share on the call side. There are people gambling it'll go to 100 a share on the put side. You're on the opposite side going, yeah, I have 100 shares. And you know what? I don't think it's going to go to $100 a share. But I agree with you. It can fluctuate. Yeah, it can go from 150 to 200 all the time. It can do that. But I'll tell you what, I'll put up my 100 shares as a risk thing. I'll risk it. by selling a put for a 190 put for $45. You give me $45, I'll give you 8 weeks until September 17th. I'll let you sell it to me for $190. I dare you. I'm more than happy to do it, because if you do sell it to me for $190, I'm only paying you $145 net. I'm really only paying $145. And you know what? I would love to buy GameStop at $145 a share. I have enough money right now in my account. I got 15 grand lying around in cash. I just added 4,500 more in cash. I have $19,500 lying around in cash. Yeah, I can buy this stock for $190. It's a $145 actual buy for out of my pocket, and I'm happy to have it. Now I have 200 shares. I had 100 shares when I wrote this contract. Now I got another 100 shares because I bought them from you for $190, but actually $145 net to me. I'm happy paying $145 for this stock. And now I've got 200 shares. I might start writing call options because the stock is so low. I might write call options against this stuff, or I'll write another put contract and I'll do it again. I'm going to write a 160 call contract against the 145 stock. Yeah, I'll keep doing this game every time. And I'll buy the third 100 shares for $105 if they go down to 10, because that's will be my net price now, or maybe even 95 a share. Okay.
So this is more of like a housekeeping question.
Okay.
If you get called,
Yeah.
and
You get exercise.
You get exercise.
Yep.
But you don't have the funds in your account. How does the house, the brokerage, decide which shares to sell to bring in the funds?
Generally speaking, the brokerage firm will not let you write the contract unless you have the necessary dollars or assets with which to do it with. So in the case of GameStop, you have 100 shares of GameStop in your account, and you're now looking to write a put contract against your position. Well, the broker knows you have 100 shares. And they also know you're going to have $4,500 in cash right off the bat. So your 168 stock plus your 4,500 cash on hand, all right, that is 16,800. That is $21,300 in value, and you need 19,000 to buy this. So they know you have more than you need to make this deal work. If the shares go down to $140. Then you are approaching an under margin situation where your value of your stock is 14,000. You have 4,500 cash. That's 18,500 in value, and you need 19,000 to cover the transaction. The broker will call you for more cash, or the broker will call you up and say, you know what we're going to do? We're going to turn your account into a margin account. Yeah. And the likely case is many of you who have options accounts now have to have a margin account anyway. And with a margin account, the broker will give you credit against your stock. And so you're covered that way, and that you won't get a margin call in that sense, because your stock will cover you.
And do they warn you? Do they phone you and say,
you'll get emails.
Be here by noon with $1,900?
On margin calls, you'll probably get email alerts, and you'll have plenty of warning as to what to do. Keeping in mind one other thing, that we're talking about an 8-week contract here. And if in 3 weeks from now, 4 weeks from now, the stock is dropping and your book value is rising on this contract as the stock drops, that's a problem. But the good news is that the time value is shrinking as well. And so the value of the contract, even though you received $4,500, it might only be trading at $3,500. And so you're looking at the stock going, oh, gee, it's down $15 a share from 168 to 153. This put's getting more valuable on a book value, but in reality, this premium is dropping because the $2,300 in time is now only worth $1,300 in time. You might just decide to pull the pin on this transaction. It's not working for me. I'm going to buy these back for $3,500 and keep the $1,000 in cash and keep my shares, which are down in value, but I have 1,000 against the drop in value here. And now I'm going to reassess. I might rewrite a brand new contract, but I might now write a 170 put instead of a 190 put. And I'm going to do that for October. 2 weeks further out, 3 weeks further out, bring in another $4,500 and realign my position. Again, these are aggressive option strategies. This is aggressive. You're going to do this in theory. If you own 500 shares of GameStop, you might write 4 puts instead of 5 puts. You've got that extra 100 shares to give you extra range. Your broker will tell you when you try to write the contract what margin requirements you have and how much excess cash you have or credit you have. If you have a margin account, you should be fine. Yep.
Sean and Wendy, let's say you have 1,000 shares. Would you stagger your contracts so you would have like 2 contracts that are good for 1 week, 2 contracts that are good
2
for
weeks,
a month,
3 weeks, 4 weeks, 8 weeks.
instead of putting all your eggs in one?
You can certainly
put?
you can certainly consider doing that. Absolutely, you can consider doing that. If you've got 1,000 shares, you can do 10 contracts, and you might decide to do 5 that expire in 2 weeks and 5 that expire in 6 weeks. You can do 2, 2, 2, and 2, like every 2 weeks, 2 contracts every 2 weeks coming up at various strike prices. Absolutely. It's a question of how much time are you in front of your market, your computer, and how many times a day you can watch this, and what your risk tolerances are. You might literally write this contract right here. Let's say you wrote just 2 of these at 45 apiece. And the minute you get the confirmation that you sold them at 45 apiece, you turn right around right now. You put a buy order in, good till canceled buy order. I want to buy them both back at 21 bucks. No matter what, you just put the buy order in and you forget about it. You watch the market from time to time, but you just have a buy order at 21 because your thinking is that in the next 2 to 3 to 4 weeks, as half of the time of this contract expires, as it evaporates in time, from now to from July to August, this contract will lose time premium. And if the shares do a fluctuation down to the 160 level, or they go up to the 175, 180, they go up a little bit to 165, 180, 175 to 180, and the time is shrinking, these will drop in value dramatically, and you'll get them back at 21. And you'll sit back and go, yeah, I made $2,400 profit on that contract. Thank you very much. My stock went up to 174. The time evaporated by half. That combination of a bit of an up move on the stock and the evaporation of time came in to help me out to score my $2,400 gain. Now you don't have a contract against your stock. Your stock's sitting at 175 or 178 a share. And you're looking at it going, I'm going to write a new put contract. It's a 60-day put contract, 2 months. And it's going to be about, instead of a 190, I'm going to write a 200. I'm going to write a higher put to bring in another 4,500 bucks. And guess what I'm doing? I'm putting a buy order to buy it back at 21 a share right now. As soon as I sell it, I'm looking for another $2,400 gain. And if this stock fluctuates up to 188 to 190 and 2 weeks go by, 3 weeks go by, this will drop again to the low 20. I'll get filled again. I bought that put back. I made another $2,400 on my stock. And oh, by the way, the stock went from 168 to 175 to 180 to 185. Like you've been predicting it would go higher. It did. Thank you very much. This is the opposite of writing the calls. If you think the stock's going to go down, you're writing in the money calls. These are in the money puts. The other direction, you think it's going to go down, you're going to write in the money calls. Because as the stock goes down in price, those in the money calls get cheaper and cheaper as the time shrinks as well. Book value and time come. You might write them for 35 or 45 a piece and buy them back at half the price. Again, automatically, with just an automatic buy order, and you don't care if they keep going lower than that. You've scored your first 50%, and that's all you wanted. You wanted a quick hit. You didn't want to wait 8 weeks. If you got this thing in 2 weeks, you're a happy camper. You're out, and now you're going to rewrite a new contract. But you're going to figure out how many days are left now. Oh, we went 15 days. I need to write a new contract 2 weeks longer than the last one. And I got to figure out the pricing to get the premium I want. And the market will tell me if the stock went down 10 bucks, I'm going to write a new contract at a $10 lower price 60 days out. Or I'm going to write a new put 60 days out at, again, the strike price that's appropriate to get me the premium I want. There you have it.
So we're going to roll a few of them together here to say that margin calls are horrible and can hurt you.
Yes.
So pay attention.
Yeah, that's true.
That the delta tells us both the odds of the contract and how much it will bring in per dollar. So 0.63 delta is 63% chance of being with it. And when my stock goes up $1, the contract goes up
63 cents or
So
down
that's-
63 cents.
That's going to come through whatever platform you're using.
Yes, but it's
Yeah.
irrelevant to it's true, but it's also something you don't have to really pay attention to.
Right. But the different
But it's-
platforms offer you these
They do
various
offer these.
analyses.
They do, yeah.
Aurora wants to know, has she got everything? So with writing a call, the money that you've brought in is yours. You
Yep.
can take it out, you can spend it, you can buy a new dress, go to town. But with writing a put, do you have to keep the funds that you brought in? Do you have to keep them in the account
Nope.
while the contract is in place?
No, you don't.
So that, again, depends on your platform of what, do you have to have a margin account?
Exactly.
Yeah.
Now the company you're using, the brokerage firm you're using, whether it's an online platform or whoever you're utilizing these trades through, they will when you write the whatever contract you're writing, a call or a put, before the trade is even entered, it'll tell you the margin requirement and whether you have it or not. And it might show you excess margin. It'll say like you're about to write this call contract or put contract, and you have excess margin of $3,000 or something like that. Well, on a one contract scenario, $3,000 excess is $30 a share. So if you're writing a contract against GameStop, well, $168 stock, you have $30 coverage, either up or down, depending on which contract you're writing. If you're comfortable with that, great, you're okay. But if the brokerage firm, the option moves against you, the stock moves against you, and that means the option is maybe moving against you, you'll see your margin requirement shrink, your margin availability shrink every move of the stock. Generally, though, with a margin account, you should have about a 2-to-1 ratio, which is plenty, and you should be just fine. Yeah.
Right. So Christina is asking, so how do you close a put, going with the buy as an open, sell as a close? How do you close
All right.
put?
Okay, well, when you're doing this transaction here, you are selling the put as your first transaction.
And that is your open.
That's your open. You're selling to open. So you're bringing in money, you are a seller. Whenever you're getting money, you sold something. Whenever you're spending money, you bought something. And so this is a sell to open transaction. And if these contracts go down to the $20 mark, you are buying to close because you're spending some of that money to get them back. And the difference is yours. So whenever you are a writer, you're selling first. And when you're closing your position, you're buying them back. Now, if these contracts go from $45 in book value to $0 in book value, because the stock goes up to $191 a share on the last day, this contract will have a $0 value. You keep all $4,500. You don't have to buy it back. You let it expire worthless. You don't buy it back. On Friday night, it expires. Monday morning, it isn't in your account anymore. The $4,500 is in your account. It's always going to be in your account, but you're not liable for the contract anymore. You can now write a new one. The strategy I'm employing, again, aggressive option writing strategies. You're writing this call or this put to buy it back at a lower price. You want to sell it for $45 and buy it back for less money. The lower you can buy it back for, the more you clear. So if you can make in a week, if this contract goes from 45 to 35 in 1 week, you could buy it back and score a $1,000 profit if you get it for $35 a contract, $35 a share. If the contract over a month drops $10 or $12 or $15, again, you'll make $1,000 to $1,500 in the month. If in the 6th week it finally drops to $30 because it just wasn't dropping because the stock was not cooperating with you here, but in the last week or two, it finally gives you this opportunity to buy it back for $1,000 less, $2,000 less, $1,500 less. That's when you buy it back. These aggressive strategies, I'm trying to get you to take advantage of these massive premiums, time premiums that are built into these contracts. I want you to score from the wristwatch going by, and every hour that's going by is your hour coming to you. The holder of these contracts, the guy bottom, the guy or the girl, they're the risk taker. They are gambling big time. They need this stock to drop from here down to 145 just to break even. They need it to go below 145 to make any money on this bet. You're sitting there going, I don't think so. I think this is going to be more than $145 a share between now and September. As a matter of fact, I think these shares can go back into the 180, 190 range because they were at 250 a month and a half ago. I think they go back to 190, $200 a share. That's what I think because I'm a GameStop believer. I love Ryan Cohen. I love what they're doing. These shares are going higher. And if they go higher, they go over 190, these contracts are worthless. You keep all 4,500. Now, you might buy them back at $20 a piece to score your $25 gain. You might decide to buy them back at 15 to score $3,000. You might decide that, no, as soon as they're down to 35, I'm buying them back. I want to make $1,000 at a time. Quick. I want a quick $1,000 transaction and I'm out of here. And now I'm going to reposition myself with a brand new trade. And I'm going to sell another put contract all over again, but at probably a different strike price at a different expiry date so I can bring in this $4,500 starting position because that's how much money I want in my account. I want $4,500 in and then I'll spend $3,500 to get out. And I'm happy doing that every week if I can get it. You give me that every week, I'll take $1,000 a week from you every week. But if it takes me 2 weeks to get it or 3 weeks to get it, fine, I'll wait it out. But I, as an aggressive writer of contracts, I am looking for the clock to work in my favor. I'm looking for the stock to move higher. In the case of a put writer, I want the stock to go up. And if it goes up to 174, 176, and a week goes by, I've got two things working for me. 1 week of depreciation for time, and the stock went up $6-8 a share. That put this contract worse off. It made it worth less money. And so the higher the stock goes, the lower the book value on this contract. Because right now it's a $22 book value. This thing goes up $12 a share. It's only got a $10 book value. I score. There you have it.
They would like to see these examples on SoFi.
Okay.
So here you have a stock that does not have the wild swings, that the premiums are not going to be as high.
True.
So do you want to do a call and a put?
Well,
or do you just want to do a put?
Let's just take a look at it together, all right? Because on some of these stocks, it doesn't work very well. This strategy doesn't work very well on some of these stocks. But let me take a look at SoFi, and let's take a look at what we can do as a writer. Because again, I'm not telling you to write contracts on SoFi these days at 15 a share. However, what about writing a put? Because we think SoFi is going to go up. Because we all think SoFi at $15 a share is kind of cheap, don't we?
And they're going to want to know why. Like, why don't you want to write a call right now? So
Okay.
it's a good example where GME is one end of the spectrum, SoFi is kind of the other end.
Right, and SoFi is 1/10, not even 1/10 of the price. It's like 1/11 of the price of GameStop. GameStop 168, SoFi $15. It's like 1/11 of the price, right? 11 times $15 is 165, just to kind of put it in perspective. All right. Well, let's take a little look-see here of what the dealio is. If you have...
What's the dealio, Bob?
What's the dealio, Bob? What is the dealio? All right, SoFi closed at 15.10. So, SoFi shares closed at $15.10 on the market on Friday night. And if you want to write, you want to be an aggressive writer of contracts. Here's the bad news. Look, a contract that dies this Friday, July the 23rd. Let's start right.
Contract?
Well, I'm gonna talk about both of them. But
Okay.
July 23rd contract. So that dies this Friday. All right. If you're a gambler and you're going to have to be a serious gambler here, here's something to think about. All right. What if you're thinking, the stock's been down for 4 weeks in a row, and I bet you it's going down to $14. It's going to $13. It's just going to keep on going down. I just have no faith in this thing right now. Eventually, I think it's a winner, but right now, it's just going lower. You could write an in-the-money call contract. So let's talk about a call contract. And we'll talk about a July 23rd contract. And we're going to write a $14 call contract. Here we go, $14 call contract. If you write a $14 call contract, you would have received on Friday night $1.50 a share. Okay? For 100 shares, you would have got $150. All right, there we go. Now, if On this Friday coming up, the shares are under $14 a share, $13.99 or less on Friday night's close. You can keep all 150 bucks. All right. Thank you very much. That's 10% of the value of your stock. You could literally buy the stock on the open market for $15.10. That's $1,500, $1,510, and you would score a $150 net profit on a contract, a $14 contract in the money, if the stock went down below $14. Well, $13.99 or lower, you keep all 150 bucks. If the stock were to close at $14.50, just, it's in the money by 50 cents. This contract will close at 50 cents in value, or $50 on Friday. And so you will have scored a $100 gain on this deal. You received 150 bucks. You got to buy it back for 50 if you buy it back, and you scored a $100 gain. If the stock were to close at $15, right where it is now, this contract is worth $1 each book value, and you'd have to buy it back for $100. You would lose $50, all right, on Friday. If the shares close at $16 a share, a little higher, they go up a little bit, the contract is worth $2 book value, or $200, and you would lose 50 bucks. So that's the risk you're taking, being an aggressive writer of call contracts in the money at $14 a pop when the stock is trading at $15.10. Writing these, you will get $1.50, but you could win or lose it all. You have to decide what kind of risk tolerance you're going to take here. Well, the higher the shares go, you'll be bought out. They will. If you don't do anything, they will exercise your stock at $14. They'll buy it from you for $14. You already got $1.50 for the stock up front. You're selling for $15.50. So as soon as you write a $14 call for this Friday, you've pre-sold your stock theoretically for $15.50 a share. If they go to 16, you only get $15.50. Okay. If you want to get out of the contract on Thursday afternoon or Friday morning, you just want to buy the call back and write a new call. You can buy this call back perhaps for $200. You'll lose 50 bucks a contract, 10 contracts, $500. But you know what? You're going, yeah, I lost 500 on this transaction, but guess what happened to my stock? It went to 16 from 15. I'm up $1 a share, almost $1 a share. Maybe I'll write now $15 contracts for next Friday in the money, or I'll write out of the money contracts for next Friday. Maybe I'll write 17s for next Friday. It's all up to you. All right. That's a call contract on SoFi on this example. All right. Let's do a put contract to go the other direction. So we're going to do, this is calls. Now we're going to do puts. All right, same time frame, July 23rd. We're going to write an in-the-money contract, a $16 put contract. So it's a $16 put contract. Expires on Friday, coming up. You're going to bring in about $1. Okay, there's $1 or $100 per contract. So if the shares, you have a $16 put contract that you've written against a $15 stock price. If the shares go up to $16 by the end of the week on Friday, these contracts will have a zero value, and you get to keep the entire $100. So it's $16. All right, it is a little better. $16 share closing price. These contracts have a zero value, and you've made a profit of $100 per contract because you got paid $100, and now you don't have to buy them back. But if the stock goes to $17, goes even higher, this contract is still worthless. You've scored $100. You're good. If it stays at 15, doesn't go higher, this contract has a book value of $1 a share, or its a value is $100. You break even because you got $100 when you wrote it. You're gonna have to buy it back for $100 at the end, and you don't make any money. If the stock goes lower to $14, let me do that over here. It goes to $14 by next week. This contract has a $2 book value, or it's worth $200. You only received $100 when you sold it. You got to buy it back for $200. You lose $100. The lower the stock goes, the more you lose, because puts go up in value when stocks go down, and you're looking for the opposite. So you can go either direction on this deal. You can write a $14 put that's in the money. You can write a $16 put. $16. Let me start again. You can write a $14 call that's in the money, or you can write a $16 put that's in the money on SoFi for next week Friday. You either bring in 150 on the call, bring in $100 on the put, and you either win or lose depending on the direction of the stock. Okay, stock stays the same. The call makes you money. The stock stays the same. The put you'll be basically breaking even because it's worth right now 90 cents in book value. Where am I at? No, it's yeah, that's right. It's at $15 a share. You will break even. All right. So if the shares go up to 16, the call price, this contract will have zero value. You'll score $100 on the put. If the shares go to $16 in actual fact, this call contract is worth $200. You will lose $50. Again, it's the opposite on each one of these. I hope this is working for you. I hope you're doing it. Can you roll it over? Yes, you can. You can always, let's say Wednesday, you can sit there on Wednesday and go, well, this contract is still sitting at $150. It hasn't gone down because the stock has gone up. I'm going to buy these back and I'm going to write July 30s. Just going to add 7 days to this contract. I'll just write July 30s, same price. I'll roll over. I'll go forward. Now, in reality, the $14 contract, if the stock's still at 15, it won't be at 150. It'll probably be at about $1.20 because it's losing time by Wednesday. It's losing a lot of its time. On the other hand, if the shares reach up to $16, this is worth $220. You're losing money, but you can always buy these back and then roll into July 30s and now write 15s. You're in the money. The stock's at 16, you're writing 15s. Stock goes to 17, you're writing 50. You're just staying in the money looking for a drop because that's what you're hoping for when you're running against a call, because you're writing an in the money call. You're looking for the stock to come down to this level. On the put side, if the puts the stock goes up, the puts will not make you any dough. But if the stock goes down, which is what you're looking for because you wrote a put, you're going to make money. And so there's your strategy right there. It's an aggressive strategy. You can roll forward if you want, but there's not a lot in it. I mean, you have 500 shares and you're making $100 a share maximum profit. There's not a lot of premium here. If you're going to write contracts that are longer in existence, say you're going to write August contracts, you want to write August calls in the money, say August 27th, the end of August, that's a month from now. You can write 1450 calls and bring in about $2 a call. Obviously, that's a much better premium than writing a 150. You get a higher premium. On the put side, if you write, say, the 16s, you'll bring in about $2 instead of $1. So you'll bring a higher premium in for those. It depends on how aggressive you want to be. The theory might be, though, that you write these puts for $2 each that have a month to go, because in 2 weeks from now, you want to score that 50% gain. You just want to buy them back for half the price you sold them for. So if I can sell them for 2 and buy them back for 1, I'm a happy camper. I've made 50% return on this wager. On my calls, I sold them for $1.60. I buy them back at 80. I'm a happy camper. I don't need to wait till the end to score my deal. I'm happy scoring a 50% deal anytime. Now, if that's with one contract or 6 or 15 or 20, it's totally up to you as to how much money you want to risk on this deal. Okay. Let's see. Yay, puts seem good on SoFi. Thanks, Auntie Jen. It's a great example of wires to adverse to writing contracts on SoFi. You see, my thinking for you guys is I want you to be an option writer on SoFi, but I want you to be bringing in not 50-cent yields or dollar yields. I want you to bring in $4 or $5 a contract. So I want you to write SoFi calls. If the stock reaches 25 a share, 30 a share, I want you to be writing $35 contracts, call contracts, for example. So you might write like a 5, 6, 7 week contract where the stock's at 30 and you're offering your stock at 35 and you're bringing in $4 or $5. If you're wrong and the stock goes up on you, you're being taken out at 39. which is great. I'd rather you be taken out at 39. I don't necessarily want you writing $20 contracts and bringing in $1.50 because now you're only going to bring in a 21.50 when you could have been bringing in $5 a share more. The premiums are so small that there isn't that much into it. And at 15.10, I am so biased on the upside of this stock. My thinking is these shares will rise back to the 2025 level without too much difficulty. The problem is we have to get through the selling wave that we've been enduring now for 4 weeks, which I think we're just about through, but I can't guarantee it. And so at any time, I feel our shares could pop $2 or $3 a share. And at that point, I would not want you to be writing $15 calls against your stock or out of the money, like in the money $14 calls, because this is too aggressive for a stock that has come down so much from 24 to 15 in 4 weeks. I think we're at the low trough here. So I'd rather you be buying calls long-term out and being a long buyer for Januaries or longer with a $12.50 exercise price or 15 to take advantage of this $5, $10 up move that I'm certain is going to come. And that way you will score a 3, 4, 500% return on your money. That is what I'm looking for you, where if you can get in at 2 and get out at 10, or get in at 250, get out at 10, making 4, 5 times your return. Now we're talking. And now you're going to buy the stock with those contracts going up like that. You're going to take the contract money, buy shares at $20 a share, $22 a share, and now start looking to write contracts against them for enhanced income. But these aggressive strategies here are for those who really want to push this thing around. This is why I've spent so much time on the GameStop shares, because the premiums on the GameStop are ridiculous. They're incredibly big and fat and juicy. And I would love to see you write to August 20 contracts, August 20, that's a month from now. And if you can write call options or put options, like a call option, a 170 call option, that's right at the money, a couple of bucks out of the money. You could bring in $21 for a 170 call that has a month to live. The stock's 168. Literally, you could buy the stock for $168 now and bring in $21 a share right now in cash, offering them up at 170. That's a 191 selling price for a 168 purchase. I like that deal. You've just lowered your cost down to 147 a share. You bought them at 168, you got 21 in, your cost is 147. If in a month the stock doesn't go over 170, these contracts will die worthless. If the shares go to 180 at the end of the month, you can buy them back for $10 each. Well, you sold them at 21. Thank you very much. You're making $11 profit. Your stock went up $10. That means you're up $12 on your stock. You're up $10 on your contract. You're $22 a share richer. And now guess what? You're going to write another contract for a month. Now you're going to write 180s. And you're going to bring in $21 again. You're selling out at 200. You bought at 168 originally, 147 actual net price, because remember, 157 net price. You scored a $10 gain here on this one example. And you're going to get out at 200. I like this deal. And these are just being aggressive with the stock. You're treating the stock as an entity, not as a friend and not as a pet. You're saying to GameStop, I love you, but I'll tell you what, I love money more. And I love making money more than I love holding the stock. I love making money. So I'm going to buy this at 168, or I'm going to use 100 shares that I've got, or 500 shares. I'm going to write calls right now for a month. And I'm taking the $20 a share right at the money. I dare you to take me out. If the shares go down to 160 in the next month, they sit at 160, I keep all $21. And I'm going to write 160s next month for another $20 for 1 month. And they stay at 160 or 155, I'm taking that $20 again. And I'm going to write another contract, a 155 or a 160 for $21. And I'm going to do this every month. I'm taking $20 a month in cash as long as you do not go up. I'm taking $20. That's $240 a year on a 168 stock. Every 8 months, you can buy another 100 shares for cash. That's in 12 months. That means you're buying 150 shares. Now, of course, as soon as you get from 100 shares to 200 shares, you're writing 2 calls because you're now doubling up. If you have 500 shares now and you're writing 5 calls right now for $20 a share, you're bringing in 10 grand right now. And if you bring in 10 grand next month, that's $20,000. Guess what? You can buy another 100 shares with 20 grand because it's 168 or so, 170. You now are writing 6 contracts at a time instead of 5 contracts at a time. You're compounding your bet, your premium. This is the strategy that you would employ. Let's go. Yep, there you are. Wait until the stock hits 28.30. That's a higher premium. And calls, puts. We've talked about both of those. There we have it. $20 put. October 15 is $5.80 on SoFi. And in theory, you could write right now you could write that put, but you're looking for the stock to go higher. And if the stock does go higher, you will score the deal, because this put will drop in value if the stock goes up, right? If the stock goes to $20, this put contract that's on my screen right there, this put contract will become zero, have no value. You keep all $580 per 100 shares. You got 1,000 shares of SoFi, there's $1,500 being handed to you. In effect, someone could sell you stock at $20 a share, but they're giving you $5.80 up front. You're paying $14.20 for it. Are you happy paying $14.20 for more SoFi? Then write this put contract. There's a, but now this is a October contract, not a January, not an August or September. It's in October. So that's almost 3 months from, or 3 months from now. Yeah, August, September, October. So that's a 90-day deal. But if the stock reaches $18 between now and October, the value of this put is actually $2 book value plus whatever time premium has left on it. And it could well be down into that $3 range, $3.20 range. You could then buy those puts back and score the $260 contract, $260 a contract in your pocket. You can do that. There's many ways to play this. All right. Does the price of the stock we paid matter? We bought 250 saved to have net loss. That's true. The contract market doesn't care. The options market doesn't care what you paid for the stock. Whether you bought it at $80 a share or $280 a share, the option market doesn't care. The option market only cares about one thing. What's the price of the stock right now? That's the number one thing it worries about. It's 168. That's where GameStop is. 168. Whatever you paid for it is irrelevant. It's true. If you were to write a 170 contract and bring in $21 a share and get taken out, you're selling at 191. Yes, you bought it at 250. You just sold at 191. You have a $60 loss. That's a tax loss. Turn around right now, however, because the stock is at 170 right now, 168. You got taken out at this price, but you got taken out you got 191 for your stock. It's trading at 170, 175 because you got bought out at 170. You buy them back at 175 and now write 175s for $21 contract premium. That's a 195 sellout, right? You get taken out again. The stock goes to 180. They take you out. Fine. You turn around, buy the stock back for 180, which is less than what you just got, 191. Write a 180 contract for $21. You get taken out. You just got $200 for that stock. It's trading at 190. Buy it back for 190. Write the 190s for $21. You're getting taken out at 210. Add up all the $10 bills you've been making every time you got bought out. You bought the stock at you wrote at 168. You got $21 for the 170s. You had to buy the stock back for 175, but you got taken out for 190. There's $15 left in your account. Then you did the next transaction. You scored a $10 gain on that one. You did the next flip. You got $35 cash on your hands, and you have 100 shares sitting at 190 a share. You're sitting now at 225. You're getting closer to your break even, aren't you? You don't mind getting taken out. If there's a premium on top of the contract, you don't mind getting taken out on top with time premium being paid to you. Absolutely not. All right. Great. Thank you. Oh, you guys are all welcome. I love all your comments. Love all your questions. I usually have Jen do them, but right now Jen is talking to somebody outside. There you have it. When you are buying a call or a put, when you're not, as a speculation to go long, you are buying to open. And then when you get rid of it, you're selling to close. If you are a creator, if you're a writer of contracts, a writer of a call, writer of a put, it is a sell to open. And remember what I always tell you about when it comes to trading contracts. I'll do this last point. If the market on the contract, I don't care if it's a call or a put, if the market is $20 to 2080, that's the bid, that's the ask, and the last trade was say 2050. Okay. I want you to keep something in mind here. I want you to understand if you're a seller, you're a writer of a contract, you're selling a contract. This is the market, 20 to 2080 that you're thinking you're selling this particular contract. And this is the market you're looking at. The last trade was 2050 a share. You are not going to sell this thing at 20 bucks. You're not going to come in there and say, oh, I'll sell my contract at 20. No. You put an offer to sell your contract at $20.75. You are at the moment with that offer for your 1 or 2 or 10 contracts, you are the cheapest seller on the board. The market might be 20 bucks on the bid, but the offer now is here. So the market now is 20 to 2075 instead of 20 to 2080. All right. If you're writing a call, for example, and the shares go down in price, you might find that the buyer changes to a 1990 buy, and you may find that there's a seller at 2070, and that's not you. You're at 75. The market just shifted because the stock went down. What you can do now is you kill this order, you cancel this order, and you change it, and you come down here and you make it 2065. You're offering and selling at 2065 a share, a nickel under the guy here, rather than hitting this bid. If you'd have hit this bid right away, you sold it at 20. You're out at 20 because you know that was the market. You could have got theoretically 2075 or maybe 2065, but you didn't. You just sold it right here. Well, the difference in dollars, 65 cents a contract, that's 65 bucks in your pocket. 5 contracts, that's $325 you gave away by just hitting this bid. No, you don't want to do that. 10 minutes later, the stock goes back up again, comes back to where it was. The market now is 20 here, and it's at 2065 here, because why? You haven't changed your sell order. You notice that this bid just came back up a dime. You're going to kill your order at 65, and you're going to put it out there at 2070. You're going to raise your price by a nickel. That's $5 a contract, because you're not a sap. You're not the guy trying to get a cheap sell price. You're trying to get the highest sell price you can get. If the shares go up another 20, 30 cents on you, and you know how these go, a GameStop, I'll talk to you about the GameStop shares, and I'll tell you that it's 168.50, 168.90, 179, 170.30, just went up like $1 in 2 seconds and 5 seconds and 30 seconds. Could well be that during one of those little rushes, you get taken out at 2070. And you sold, you're out. Well, you know what? Compared to what you could have got versus what you got, $70 a contract, that's 70 cents a contract is $70 in your pocket. Same on the buying of it back. When you buy your contract back, you're doing the opposite of this whole thing. What you're trying to do now is you're trying to get the best, you're trying to buy it for the cheapest price possible. So on the bid side, and the ask side, sorry about this, folks. All right, so the market is, let's say the market's gone down, and the market is now 10.25 bid and 10.75 offered. You wrote it. Remember, you wrote it for 2070. You sold it for 2070 when you sold it or wrote it, and you ended up with a 70-cent better price than if you had hit the bid. Now you need to buy it back. Right? You sold it at the top dollar. Now you need to buy it back. The cheapest offer is 10.75. The best buyer is 10.25. You come in at 10.30. You come in here at 10.30, and you make the market 10.30 to 10.75. You don't go in there and buy a 2.75. Oh, no. You're not going to. Why would you pay this? No. You're the cheap buyer now. You're trying to maximize your profit. If you can buy it at 10.30, having sold it at 20.70, that's a 10.40 profit in your pocket. Okay, so the shares, adjust in price again. They go up, they go down. You'll notice that there might be a 1040 buyer come in because the stock went up in price, and it's 1085 on the sell side. And you might be sitting there going, "Oh shoot, I could have just bought them at 1075. Now I got to pay 1085 because that's the cheapest seller. Gosh darn the heck! I'm trying to buy them at 1030, but there's a 1040 buyer. Oh geez, I'm out of the market. Don't worry about it. Go in at 1045. Just be a nickel higher than this guy. You're the best buyer on this contract. It's now 1045 to 1085. Okay? 15 minutes later, the stocks take a $2 tumble. You know how this works. The stocks go down and you get taken out. You get hit at 1045. You get the contract at 1045. All right? Well, guess what? You didn't pay 30 cents higher than you could have right off the get-go right here. Because originally you could have just bought them at 1075. You didn't do it. You didn't pay that price. You bought them at 1045. You saved $300 on this side of the contract. And over here, you didn't sell them out at 10 at that first price. You scored that 50, 60, 70 cents a contract. I think it was 70 cents. $70 you made there. So you made $70 here. You saved $30 here. You've just made yourself $100 a contract more in profit because you're a chintzy buyer and you're a greedy seller. This is the secret to success in the market, and especially after the 20th time you do it, the 40th time you do it, the 50th time you do it with just one contract. Every time, if you can score a $100 bigger gain on every flip you make, 10 flips, that's $1,000 in your pocket. You're doing 5 contracts at a time. We're talking $500 per buy and sell here. 10 times those, that's $5,000 in your pocket. We're talking huge money here. These little pennies, nickels, and dimes add up to a lot of cash. You're not giving this away. You're taking this money. So yeah, you might have to wait hours to sell your contract at the price you want. You might have to wait hours to buy the contract back at the price you want. That's because you're greedy. That's just the way you are. And you are not going to cave into the market. You don't have to cave into the market. You're the best buyer. You're the lowest seller, whichever side of the market you're the market maker. You've decided. No one is undercutting you or overcutting you, getting ahead of you. You're the authority. That's where you sit, and that's where you sit. You watch your market, because you know when I entered the trade to buy the contract, the stock was here. Then the stock went up. I have to lift my price if someone jumps over me. But if no one jumps over me, I'm not moving. If the stock goes down and all of a sudden you see the offering price go down, you kill your buy order and you back off. You back off 10, 15 cents. You might kill your buy order entirely and just see what the market looks like now. Because the market was 1030 to 1075 or whatever, and then the stock backed off. You notice when you killed your buy order, the market was 1025 to 1075, or it's 1010 to 1075. If it's 1010 for the bid, you go 1015. You're the highest price buyer now again, and you're waiting for the stock to come to you. And if the stock drops enough and you keep lowering your buy price, and eventually you buy this stuff at 980, you buy the contract at 980, and you were prepared to pay 1030 originally, and you end up paying 980, that's $50 a contract less than you're paying times 5 contracts, $250 less than you're spending of your money. That's worth a little bit of your attention. That's worth your attention. Because if that took you an hour to do this, you save $250 in an hour by being a chintzy buyer. Hey, that's making $250 an hour, buddy. That is good. That's $2,000 a day. That's $10,000 a week. That's $500,000 a year. That's a nice salary. These nickels and dimes add up to a fortune in gains and losses. And this is where you want to be the chintzy buyer and the greedy seller. Okay. Another little safety tip for you right here at the end of our class. I hope you enjoyed it today. I want to thank you all for being with Jennifer and I. I hope you're learning a lot from this and getting wiser and more comfortable with these terms and these entire strategies. There is no end to it. They just keep coming out. In future classes, I'm going to start talking about the psychology of the market. I'm going to talk to you about how you survive the brain gyrations you have to go through, how to read a market while the market is happening. I try to do this on the air with you when I'm on the air every day. I'm going to try to help you learn that. I'm going to try to help you figure out how to be a smarter buyer, a smarter seller, especially on larger orders. We're going to go into stuff like how you can figure out what stock to buy, what you should be looking for, fundamentals. What kind of fundamentals should you be looking at stocks so you can become a smarter buyer? You can be a wiser purchaser of securities. How to avoid companies that are clearly on the downstroke and are really in trouble, maybe financially or corporately. How to find and identify winners. Uh, what kind of figures or ratios you need to be watching for, price earnings multiples and that kind of thing. We'll go into that. We'll talk about how to kind of look at stock charts to kind of give you a handle on what's going on, maybe help you predict a little more of the future. We're going to cover all kinds of areas going forward on the markets and on options. And if you have any questions or suggestions, let me know. Send me a private email. Say, hey, Bruce, I'd love it if you could do a class about this, or could you do a class about that? I'll look into that and see if I can add that into a class coming up and go that direction. Thank you, everybody, so much for being here and following me today. Have a great rest of your day today for Sunday. Stay healthy and make sure you get your vaccinations. And I'm looking forward to catching up with you again next weekend. We'll be announcing our new classes tomorrow for this coming weekend coming up. Thank you so much, Sean and Wendy. Appreciate that so much that you're here. Thank you, Uncle Bruce and Andy Jen. You're greatest of all time options explaining. Frank, it's love. It's love to know you pick your SPACs. I love to know how you pick. I'd love to know that. Beach Boy, ND limits in the future. Uncle Bruce, are you planning to get into stop loss? We can talk about that as well going forward. All the different terminology. I'm thinking about doing a class to get into all the terminology of the markets for ordering and everything else. Frank, thank you so much. Vernon, thank you so much. Aurora, thank you. And we'll see you tomorrow at 8:30 in the morning. You bet. Thanks, Nander. We'll be back on 8:30 a.m. tomorrow morning, as always. And for me, that's only like 10 hours from now. So I got 10 hours off before I have to do anything. This is fantastic. I get to relax. No, actually, it's more than that. I get 22 hours off now. It's only 10:44 my time, actually. So I keep reading it wrong. So I almost get 24 hours to get ready, but I'm not quite not doing anything. I'm going to be quite busy here setting things up. But I love you guys. Thank you so much for being here, hanging out with Jennifer and I today. We do appreciate it. We'll see you tomorrow morning at 8:30. In the meantime, thanks for joining me for these classes, and we'll look forward to joining you on the next batch. And we'll talk to you a little later. Have a great day, everybody. Take care, and bye for now.